Hi, Joe Kehrig with the Kehrig Real Estate Team, and this is your San Ramon Valley update. And what we're going to talk about today is the housing market on the road to recovery. Are we heading into a real estate recession? First off, you hear a lot of people talk about recessions. You have to remember, in 5 out of the 6 last recessions, one has stayed about the same. The other 4, the real estate market actually went up. And in the one, obviously, in 2008, the market just crashed. But overall, recession helps the real estate market because the Fed lowers the interest rate to try to pull us out of the recession, which obviously the lower interest rate over the last 30 years, the better and the more sales you have in the real estate market. But I actually think we're on the road to recovery, and I'm going to show you why right now. Look at this. The unsung hero of the housing market in 2025 has been the improvement in mortgage spreads, because without the spreads improving as much as they have, mortgage rates would not have gotten near 6% this year. So what are they talking about with the mortgage spread? Well, the 10-year Treasury and the mortgage rates have basically run parallel. And then what's happened the last couple years, as the Fed artificially has basically kept the rates high, the spread between the mortgage rates and the 10-year Treasury has widened, which means obviously higher rates. As you see the Treasury rate, basically Treasury rate and that spread shrink, the mortgage rates are getting better, as they said right here. Look at the mortgage spreads hits the lowest in years. You can see at one point the mortgage spread was 3.3% going back to July of 23. And you can see it going down. It goes up and down, up and down, up and down. But it's a little bit over 2% now, which is a lot more towards normal, what we're normally used to seeing if you go back to the last 30 years, except really the last just 3 or 4 years. But before that, now we're down closer to what a mortgage spread would normally be. That's what's driven the interest rates down close to 6%. Out of only 28 out of 1,000 U.S. homes have changed hands in 2025. The lowest turnover rate in at least 30 years. Now, obviously, there's been about the same number of sales, but there's a lot more housing out there. There's a lot more people. So the real estate market has slowed down, but why is it on the road to recovery? Look at a couple things. The turnover rate, you see it right here, going back to 2012, all the way at 33, and obviously in 2021, when the market was nuts, it was at 44%, and now it's down to 27.7% because homes haven't been turning. Why haven't homes been turning? Well, look at this. Homes are turning over at historically low rates because affordability challenges have kept many buyers on the sidelines. As rates went up and home prices went up, it priced a lot of people out. 2, sellers aren't willing to give up their lower mortgage rates. More than 70% of U.S. mortgage rates have a rate below 5, well below the current rate of just over 6%. And then the economic uncertainty has made buyers cautious. Whenever there's uncertainty in the market, everyone stops doing what they're doing. Obviously, after the tragedies of 9/11, the real estate market just froze for 3 months. Same thing with COVID. For 3 months we were in a lockdown, and then it went nuts after that. So when there's uncertainty, which with the tariffs and the economy, it's holding buyers back a little bit. But that's why things are turning right now at historically low rates. And why might that be changing? The housing market, as you can see, is starting to move again. How's it moving after a prolonged slump? The existing home market is showing signs of recovery. 3 reasons why it's on the road to recovery. Number 1, mortgage rates have been decreasing for the most of the year and lower now than they've been in the last couple of years. So remember, as rates go down, more buyers can come into the market. Number 2, as the lock-in effect eases, more homeowners are selling and inventory is rising back to normal levels. What they're talking about, the lock-in rate, you take a few years ago and everyone had 3% rates. But now you have, you'll see it in another graph, you have a lot of people that have 5, 6, 7% rates. And so those people aren't hesitating moving. And then life just happens where people, even with the lower rate, need a bigger home or downsizing, and they have to move. Number 3, lower rates and more homes to choose from are leading more buyers into the market. You can see mortgage rates are trending down. Look at going all the way back to the beginning of this year, all the way down to the lowest now we've had in the last couple years. Home affordability hit its best level in more than 2.5 years in September, driven by easing rates and a pullback in prices. You can see monthly mortgage payments are trending down. So obviously with the lower interest rate and the softening of the market, things are becoming more affordable. That's one reason why we're starting to see it turn a little bit. Wages are climbing at a faster pace. Because remember, there's really three things that are going to dictate affordability. One is people's wages. And right now, wages are still trending up. Number two is basically the interest rates. If interest rates are lower, which they are, more people are able to buy. Thirdly, there's more inventory out there and prices have gone down. So prices going down, rates going down, and wages going up all turn to the market getting better and starting to turn a little bit. You can see as of mid-September with 30-year rates at 6.26, it required 30% of median household income to make the monthly principal and interest payment on the average price home. That's still high. 30% of your wages or your earnings to make your payment are still high, but it's down from more than 32% just earlier this summer and a peak of 35% in 2023. So 30% is still high because home prices are still high. Rates, even though they're coming down, are still higher than what most people are used to. But you can see that's why things are trending better. More homeowners are deciding it's worth the move, even if it means giving up a lower mortgage rate. Life doesn't stand still. People get new jobs, grow their families, downsize after retirement, or simply want to live in a different neighborhood. So that lock-in thing about the lower interest rates, that's starting to ease because there's a lot of people out there with 5, 6, 7% interest rates. They're not having any hesitation on moving. Those needs are starting to outweigh the financial benefit of clinging to a rock bottom mortgage rate. You can see the share of mortgages rates above 6% climbs to a 10-year high as Americans adapt to the new normal. So you can you go back to 2021 and or 2022, the quarter number 2, when the market peaked, only 7%, because this is when rates started going up, only 7% of the mortgages out there were basically above 6%. Now you got all the way up to 19%, almost 20%. So again, things are getting more normal because we talk about the last normal market and look at 2017, 18, and 19. So again, the share of mortgage rates above 6% are at a 10-year high. So again, there's more people out there willing to buy because they're really not giving up a 3% interest rates. Inventory continues to grow. This is the other thing. You can see that we've now topped in 2025 over 1 million homes on the market through the United States, actually 1.1, and you can see that, again, we talked about the last normal, 2017, 18, and 19. You can see that was over 1 million. Then obviously starting in 2020, it dropped way down till the peak of the market when it was nuts. There was only a little bit more than 500,000 homes on the market, so literally twice as many now as 2021. Home sales are expected to rise. Now, these are both new and resale. We've been stuck at around 4 million resale homes. The last one will be at 4 million again this year. So the last few years has been at 4 million. In the peak of 2021, there was 6 million home sales. So again, home sales are very low. These numbers include new homes. And you can see homes for sale have increased in 2025. As we talked about, from May on, there's been over 1 million homes on the market, and it's climbing, and now it's holding a little steady. Homes are now selling at a more normal pace. Again, you go back to 2017, 18, and 19, and the average days on the market were in the 60s, what it is right now, unlike the hot market where it was 43, which I don't even know how they get to 43. There was like 3 to 4 days on the market back then, at least in this area. So what is happening in this area? And this will show you, remember we talked about supply and demand and inventory and homes, prices going down. Buyers are still out there and they're buying right now, and there's not a lot of inventory. Look at San Ramon. San Ramon, you've basically seen, because remember, the market peaks as far as homes on the market, but it starts to go down after that. And you can see the last 3 weeks, San Ramon has steadily gone down with homes on the market, and the inventory and the pending sales continue to go up. Well, we're almost at like half pendings as there are as far as listings, where we were down to 25-33%, you know, a couple months ago. The Danville market, same thing. You literally have 111 homes on the market, 55 pendings, half, 50%. They say 50%, it's still a seller's market. Well, it's a seller's market for some homes, but as we talked about before, you know, the homes that are priced right and show nice are basically selling, you know, right away, and everything else is just sitting. But you can see inventory, as it does this time of year, starts to go down. And now with the lower interest rates, the buyers are staying in the market. The pendings are actually going up. Same thing in Alamo. You can see that the inventory dropped way down. You literally have, you know, 14 pendings and only 25 homes on the market. So again, very active market there. Dublin, you know, the actives went up a little bit, but they had steadily been coming down. But you can see their pendings are staying steady. And this is what you're starting to see now. Look at everything. Now is in the 90%, you know, the 97, 99, you know, 95%. So the homes that are selling, buyers are being picky, but they're pick and choosing, and they're getting some buys on homes out there. So again, every market is a little bit different, you know, even within the same neighborhood. If you just want a free consultation and just kind of want to get an idea where your home sits in the market right now, give us a call. If you just want to chat about anything on this video or any of our videos, you want to chat about it, give me a call, 925-487-6838. Again, 925-487-6838. Or drop me an email, joe@kehrigteam.com. Or if you want to learn more about the Kehrig team and look at all of our listings and sales that we have, visit our website, www.kehrigteam.com. This market is very fluid. Stay tuned and just wait till next week. You'll see some more changes. Talk to you soon.